Good evening, everybody, and welcome to another edition of Live Market Analysis. It's a pleasure to be with you as we delve into markets, their moves, and the reasons behind these moves. I'm just going to try and maybe move myself. There we go. That's the first move of tonight, is to put me in the centre of that picture. Last time we discussed this, we said we were moving towards a full risk position again. I said, you didn't have to rush, didn't have to hurry, didn't have to get it all at once. As the market, as the setups take you, that's where we're heading, and whether you're there or not, that's up to you. But that's the final destination. Has anything changed since last week to change that notion? Well, Thursday's candle wasn't a very good one. It's just quite a scary one, actually. But we haven't seen those sorts of candles very often followed up by a big black candle or a candle that demonstrates that there isn't still demand around. I mean, the last time recently where that occurred was this one here, where, as you can see before, let me zoom in for you. The one before, the one I've highlighted with the blue line there, was the big black candle, and that candle I've highlighted reinforces the supply that is evident there in the system. Obviously, the black candle is all supply, and then we try to rally, and this is the key. Watch for these candles after the big black ones, where you try to rally back into the range of that big black candle. And the reason why you don't get very far is because there's probably not much demand around. Why isn't there much demand around? Well, that's scary, and there's probably lots of supply as well, selling into any demand that is in the market. And then we saw the spill through over the next few candles. We go to Thursday's one, and then look what we got on Friday. So they kind of negate each other, and therefore we're left with everything else, which is your trends, your price action, and the other candles, and they're all still very good. So no complaints there, no red flags just yet. Hey, Thursday's candle wasn't great, but I don't think there's anything to worry about based upon what I can see. All the stuff I can't see, which is the future, we'll worry about those things when they occur. Let's have a look, or again, whip around the grounds. Next place I'd like to go is the Russell. Look at Thursday's candle, even worse, far scarier, bigger, blacker, if that's even a thing, piercing through the dynamic demand we'd expect. The short-term uptrend ribbon, has gone back to amber. It's all very concerning. Instead of being above the highs like we were in the NASDAQ, we're below the highs. Again, this is the heart of corporate America. So if you factor out some of these moves and these big, wonderful, they're not bad, they're wonderful, wonderful big tech stocks, then you're left with something that isn't as good. And that is a little bit concerning, but we've still got uptrends here, and largely the price action is intact. It's not excellent, but it's intact. Red flags, a bit of a red flag. What is the rung under red flag? I'll let you decide. Let's head over to Europe to see if we're getting a coordinated downdraft, or it's all still pretty much near record highs. It's certainly the case there on the French market. If you're wondering what those markets are, let me undo this, because I have to do that to make the lithium chart I just made. We'll talk about that in a second. Let's head over to Germany. Hunky-dory, looks fantastic. I should mention US markets are closed tonight for the Memorial Day holidays. European markets, no doubt, are trading as we speak. Head all over Europe there. That looks fine, no complaints. And in the UK there, we're having a bit of a pullback, but nothing too sinister into the light green zone. Let's head over to Asia. Hang Seng having a little bit of a bounce off its short-term uptrend ribbon. For me, changing trends. We've talked about the changing trends in Asia, which is a good thing. The Nikkei not far away from its record high and still fine. Nifty 50 making new highs. I've talked about that in my market index evening wraps during the week. All good there. And that was not all good here. A little bit of a pullback. We've got some big data out this week. I'm pretty sure we've got the Chinese manufacturing and non-manufacturing PMIs might help out there. But we did see some moves made by Beijing last week. I'm pretty sure it's last week, unless it was the week before, where they removed the mortgage floors, the minimum mortgage requirements. So mortgages can be, in fact, cheaper. Interest rates can be cheaper over there. Again, looking for red flags, and I'm not seeing them. That's the key. Bringing it back home, we are struggling a little bit, aren't we? We look a lot like the Russell, not much at all like the NASDAQ, and we are still holding trends, but with the candles there towards the end of the chart, not looking fantastic, but still largely hanging on. 77.14 is key. I don't want to see us close beneath that. If we do, then there's a good chance we'll head down to 75.56, potentially even into the dark green zone. Well, that's about coincident. And to get us out of this funk, we need to close above I'd say 79.11, and I think would be a lock for an 8 handle if we can do that. I think for all intents and purposes, just the momentum and the excitement of that should take us into the 8,000s. I don't often do them, but I'll do them very quickly tonight. Sector indices to see if there are any changing of the guards. That's not a great development there towards the end of that chart for the consumer discretionary sector. It's as long as it holds the dark green zone, then the long-term trend is intact. But I'm going to say that's neutral at best over there. Energy sector still looks like one of the worst sectors that we're going to see tonight, and there's absolutely no joy in this chart at all. I would put to you, if anything, there's quite a high probability that this one will go lower. Financials probably more neutral as well. I know it has had a tremendous run through here, but looking at this breakdown, sideways is probably a reasonable bet for this in the short term. But long term, that trend is still intact. Gold, I'm going to go ditto on that. I mean, we're seeing some strong trends up until the last couple of weeks, isn't it? That's probably the best way to put it. That's not dissimilar there on healthcare, very much sideways. Technology still looks pretty good, though. I think that one still shows some upside momentum in the very short term. Heading over to the resources sector, slightly positive, generally trending higher, not terrible. Into property, a bit like financials, maybe more likely to head sideways in the near term. Staples sits with energy as being one of the worst sectors. Telecoms, ditto on that, and utilities is clearly the best sector out there. So I don't know if you're looking to allocate money. That's I think a pretty good guide for you. Let us head over to the trading view window, and we'll kick off. Let's go bottom up. We'll start with silver. So we've obviously seen a bit of a pullback in silver. We talked about some of these levels previously, 32.76 being one of them. We've seen some supply come in and around there. And then we're just tending now to vibrate within the very well-defined zones of supply and demand there. I draw these well in advance of where the levels are, and certainly that green zone was, and certainly 32.76 was as well. So it's almost a little bit of a roadmap, isn't it, sometimes, of how these things do play out. 30.19, as I've said to you, is now demand. As long as that zone holds, and as long as we continue to close above the short-term uptrend ribbon, the light green zone, things are hunky-dory here, and I can't see any reason why we can't continue to go higher. Today's candle, which is a live one, so you do have to discount it up to this stage, but it is looking good for now, certainly tells us that 30.19 is manifesting excess demand, and that's a good sign. Can we go back and print 32.76? I don't know. I can't tell the future, but there's nothing in the chart to suggest that cannot occur. In fact, I'd almost say that is the most likely scenario given the wonderful trends we have on screen. Let's head up to gold next of all. Doesn't look anywhere near as good. That's quite obvious. That's the first thing that jumps out at you. We've got big black candles there on screen we didn't have with silver. Instead of holding above, say, a 23.37, we're actually pushing and penetrating beneath it. Instead of holding above the short-term uptrend ribbon, we're again penetrating into it. And again, it's just telling me that there isn't as much of an environment of excess demand here on gold as there is to silver. The trends are still fairly strong, but I cannot get away from the fact that two big pushes down by the supply side, very clear pushes down with these black candles here and these black candles here, is starting to tell us there's quite a bit of supply. I'm neutral at best on gold, whereas I don't think I'm still bullish on silver. Heading over to copper, a similar reversal, a severe reversal, a significant reversal. That big black candle, big shadows into a zone which again we pegged in advance at 503 to 521. So it's happening in a place we would expect it to happen. When you get candles, supply coming in at a place you don't expect it to happen, it probably doesn't have as much significance as when it comes in at exactly where you expect it to happen. And those shadows are the shadows are the manifestation of excess supply. The only way you can get the shadows is if you're pushing up with big white candles that by the end of the session are beaten back down. And that's exactly what forms those shadows. The demand is not strong enough to absorb, to withstand the supply that's so clearly in the system. You get the big black candle, tells you the demand has given up. I mean, the demand has been filled more than anything else. They've given up certainly at those levels, in so much as there's no demand left. There's only supply. Demand will look to regroup at quote-unquote bargain areas where they feel they're getting a bargain. And those will be the pullbacks probably to areas of previous resistance, 469.5. I don't really want to see it go lower than that because that would not be a good thing. We can see how the light green ribbon is also providing dynamic support, and whilst we're there, we're okay. Close beneath 469.5 is problematic. A close beneath, say, 462.5 beneath the light green zone is going to be lights out, I think, for the short-term trend. Long-term trend is still up. I'm going to say sideways at best here for copper. So the best case scenario, I think, for the next few weeks, order of magnitude, is sideways because of the candles that we've seen. Hey, how will you know I'm wrong? You'll see big white candles come in. Okay, that's how I'll know I'm wrong. Big white candles, long lower shadows, until you see those. And the reason why I'm saying this, I think you've had lots of demand. You can see now there's lots of supply, lots of demand, lots of supply, equilibrium. That's why I'm calling sideways. Iron ore, okay, short-term trend is still up. It's got itself above a long-term uptrend ribbon. It's trying to hold that ribbon. I think that's fine for now. I wouldn't want to see it close below 114.35. Uranium, I think, it's gone to sleep, to be honest. A bit like some of the lithium minerals. That's lithium carbonate. After a valiant effort at a bounce, which was really snuffed out by supply, more supply, more supply, more supply again, and even more supply, and just demand that tried to hold on and then couldn't. I think, again, sideways is your best case scenario there if you have a look at lithium carbonate, lithium hydroxide. This is very much dead cat bounce sort of stuff. The energy complex now over there in the USA, starting with natural gas, we did note very early actually the rally here in natural gas. Pretty sure I said, look, it's interacting with the long-term trend ribbon. That long-term trend ribbon deserves all the respect that we naturally afford it, because you can see how it has been so effective in terminating uptrends before. So don't mess with the long-term uptrend ribbon. The good news is, certainly unlike this time, a little bit more like this time, it actually has to contract enough to turn amber. That's important. But what we need to see from here is some good price action in that ribbon, preferably above the ribbon, to tell us, like with nickel, that we are changing that long-term trend. It hasn't happened yet. If anything, all we've got is the manifestation of supply at that level. West Texas crude oil here, flirting with that long-term uptrend ribbon. I did think there was a chance it was going to hold it. That chance is looking slimmer and slimmer. Brent looking better, but still really struggling to decisively bounce off that long-term uptrend ribbon, which means we've got some problems. Looking at the coal contracts there, once again, long-term uptrend ribbon defining the upper extent of the upside in the price there, and not a lot happening there on coking coal. Let's head over to the bonds and interest rates and finish off our whip around the grounds with a look at the price of money, remembering that the price of money affects everything. And if money's getting more expensive, everything else is going to struggle against that, because what we're looking at here ultimately is risk-free money, because we're talking about Uncle Sam's IOUs over 10 years. And Uncle Sam, correct me if I'm wrong, has always paid his bills and is expected to continue to do so. So if you can get 4.5% risk-free for the next 10 years, investing in stocks, which, to be fair, deliver you more on average, 9-10% per annum over the last 20 years. I know that because I wrote an article about it recently. That's the difference is your equity risk premium, and you're really saying, well, a stock's worth that extra risk. I know sometime in the next 10 years, I'm probably going to have a drawdown of 40%. That's just how stocks work. So to get my extra 5% per annum, a stock's really worth it. And this is exactly why when interest rates go up, or these yields go up, which then impact market rates. Also, we know that stocks tend to struggle. We know there's a correlation. We've seen it day in, day out. Bringing it back to what's actually happening right now, we've seen a little bit of a push up in yields over the last couple of weeks, and that has caused a little bit of the sogginess, certainly in some of those broader-based markets like the Russell 2000 and I believe our own. But there is some good news for the Aussie yields, though I think they're looking a little bit weaker here, a little bit more downtrendish, if that's even a word, and the candles are probably more predisposed to trending a bit lower. But it has been a pleasure chatting with you today. Always remember to keep calm and follow the trend. and all the best for your trading and investing. Until we catch up again, bye bye for now.